For most investors, interest rates are a hot button topic. To help shed some light on interest rates and loan products investors are flocking to, we're bringing on a lender who exclusively works with real estate investors. I'm Kathy Fettke, and welcome to the RealWealth Show.
You're listening to the RealWealth Show with Kathy Fettke, the real estate investor's resource.
Today, we're talking to Caeli Ridge. I've known Caeli for 20 years now, and she is the best in the business when it comes to understanding what's going on in the mortgage industry. We're going to start the show by talking about interest rates and where she thinks they're going. Then we'll dive into loan products that investors are utilizing today. Caeli's also going to be hosting a webinar at RealWealth, and you can sign up for that for free at realwealth.com/webinars. Caeli, welcome back to the RealWealth Show.
Thank you, Kathy, for having me. It's always such a pleasure to be with you.
Oh, we were just talking about how long we've known each other since the Great Recession, when we were both in the mortgage industry then. And it's like, well, this is the mortgage meltdown. How are we going to survive this? And we did.
We absolutely did. And I'll tell you, that was one for the books, man. I remember the stress of those days and how intense it was. The people just getting into this, they don't know what they missed. Right?
Everybody think, oh, I wish I could have been there and bought then. But let me tell you, we didn't know if we were going to be the United States of America. It was a scary time. Last thing people were thinking about was buying real estate, and there wasn't any money to do it. So Anyway, good times. But let's fast forward to today. Very different, very, very, very different world today. Everybody wants to know this one question. What is going on with mortgage rates right now?
What are mortgage rates? It's top of hour. It doesn't matter what year I'm in or what conversation I'm having. If it has to do with real estate investing, that's always the first thing out of people's mouth. What are the interest rates? I do have answers for you. It's important to always start this conversation by making sure everybody knows that interest rates, like anything, are not created equal. So it is based on something called an LLPA. And anybody that's heard me talk about this before knows that stands for Loan Level Price Adjustment. So let me set the stage before I answer the all-encompassing question, what are interest rates? The following is going to be based off of a purchase transaction, different in an LLPA if we were talking about a refinance, but a purchase transaction for an investment property. We're going to assume that it's a single-family residence. We're going to assume 25% down. We're going to assume 760 or better credit score. These are conventional rates that I'm giving you right now. So guys, for you that are tuning in here, Fannie Freddie conventional are going to have different interest rates than, say, a DSCR might have, or a short-term bridge loan, et cetera, et cetera. So all of those LLPA variables are important. So one more time, purchase, 75% LTV, single-family residence, investor property, 760 or better credit. You're looking at an interest rate. Yeah, this was last night I pulled these. 6.875 is the 30-year fixed rate. And that's at about 1.5 points. So rates are not looking too terrible from my lens and where they've been and where we've come from over the last couple of years.
Absolutely. I mean, again, back in the day, we were so stoked to get under double digits.
Yeah.
And for investment property, and we just kept refining down because it got down to like 7. We were so excited. But it is, again, it's a different world. Prices have gone up a lot. And so there's impact there. You said a lot of things that a new investor would not have a clue about. Like, what did she just say? Conventional.
Is that English?
No, it wasn't. It wasn't. It was called real estate speak. So let's go to our new investors and say, what is conventional? What is DSCR? What are you talking about?
So on the spectrum, we have lots of different loan products. So I think one of the value adds of Ridge Lending is we're not a one size fits all. We have a tremendously diverse menu of loan programs. I like to call it a menu. And as that relates to investors, right, we are full service, so we can do everything. But as it relates to investors, more often than not, newer investors are going to start on the Fannie Freddie side of lending. Fannie Mae, Freddie Mac, you've probably heard those names before. These are called conventional loans, aka agency loans, aka golden tickets. I think I coined that, by the way. Anyway, those are all the same thing. And that's typically where an investor will begin when they're looking to use leverage to acquire real estate.
Because it's backed by the US government, so they're
Ding, ding, ding.
cheaper.
Right.
And you get up to 10 of those. So many people don't realize the government will let you have 10 investor loans at these sort of like government-backed rates. It's crazy. So start there.
Right. And that's why the interest rates are going to be more favorable, is because you have the United States government saying, yes, investor that purchases this mortgage-backed security, this loan, if this individual defaults, we are going to make it whole. So that's why you're going to see the lower interest rates. And it's a 30-year fixed. So I call them the golden tickets, these Fannie Freddies, is because it is the highest leverage at the lowest interest rate. So those variables that we were talking about, the 6.875 and giving you all those metrics that I gave you in terms of the down payment, et cetera, that would be for interest rates in today's market. Now, if we move from that, and there are 10, as Kathy said, you have 10 golden tickets per qualified individual. One quick note where that's concerned is that if you've got a team, let's say it's a husband and wife duo, okay, and you're just getting started, between the two of you, you've got 20 golden tickets. So remember that. We always want to try and separate the debt obligation when you have a couple that are going into real estate investing together instead of doing it jointly. Unless you need to for qualification, you always want to try and separate that debt obligation to maximize the number of golden tickets that you have.
So there's going to be some angry people and there's going to be some excited people. But the angry people are going to say, why on earth is the government subsidizing investors? Because that's 20 loans you can get. And you up to four units. So you could get 20 fourplexes. 80 units subsidized by the government. Like, why? And of course, the answer is because rental housing is desperately needed.
Absolutely. And we need good rent housing for, especially when you get into 2 and 4, I think there's a unique opportunity for the government to subsidize so that you have adequate housing for those individuals. And you've got, I mean, if we go down that rabbit hole, you've got the Section 8, even things like the mini homes that are sort of coming online. But despite that, I do want to also mention that when you look at the pie, the big picture, the percentage of mortgage-backed securities, and I'm talking Fannie Freddie right now, that are secured by investors is a fraction. When you look at the big picture, owner-occupied versus non-owner-occupied versus second home, for example, the non-owner-occupied investor slice is very, very, very small.
I'm glad you brought that up.
Yeah.
Okay, so once you've sort of maxed out your golden tickets, then what? So
then more often than not, if we're going to stay residential, and as Kathy just said, that's single family up to 4 unit. Then you're going to move into something called non-QM. And I had articulated the buzzword DSCR. So let me just quickly define what non-QM means. So Dodd-Frank, okay, this is back in the 08-09, post 08-09, 2 individuals with the last names Dodd and last name Frank. They came up with sweeping legislation that kind of overtook all financial sectors. As that relates to mortgage, qualified mortgages were born. Okay, Fannie Mae and Freddie Mac are the definition of a qualified mortgage. So everything kind of outside of that box is now deemed non-QM. Non-QM is not just for investors. It's for anybody that doesn't fit into that buy box of the Fannie Freddie. Inside non-QM, extremely diverse in and of itself, you've got things like bank statement loans to show income, asset depletion, or in our case, as it relates to our investors, DSCR. That stands for debt service coverage ratio. So whether you've just maxed out of your 10 golden tickets, right, you've already exhausted those, or perhaps you just can't qualify in the debt to income ratio where we're looking at, I call it vials of blood and DNA samples. But if you can't show your tax returns, right, you write off too much to show any adjusted gross, you're self-employed and you play the game. Whatever the circumstances are, you can't fit into that Fannie Freddie box. Now you're going to be a non-QM, and inside non-QM, more often than not, it's going to be debt service coverage ratio. So instead of an individual DTI, debt to income, it's now about the property and the gross rents of those properties divided by the mortgage payment as defined by principal, interest, taxes, insurance, and HOA if it's applicable. So when you divide those two numbers, income, rents, by the PITI, that gives you a debt service coverage ratio. And generally speaking, you want to see that at a 1.0 or greater.
So helpful. Okay, so thank you for clarifying all that.
Yes.
People are probably wondering if rates have been coming down this year and maybe the Q1 GDP, gross domestic product, is going to be negative, which I've been hearing could be, and that could signal recession, and that might mean that rates go down further. Should they get a loan now? Should they do refinances now, or do you think rates will continue to go down?
It's a valid question. It's a good question, but I think that more often than not, my response is to the individual. You have to do the math, okay, for a few reasons. First of all, this is assuming that the value of your property stays the same as it is today, and there's no faltering. Because if your value goes down, are you still eligible to even get a refinance? That would be the first thing. And to layer into that, are we looking to do a cash out refi where we're harvesting equity? Remember, guys, borrowed funds are non-taxable. Or are we simply refinancing to reduce our rate, aka improve our cash flow? So a couple of questions revolve around whether we're going to start and do it now, or we're going to try and wait on a come that says interest rates are going to be X down the road. But the bigger question for me is, have you done the math? Depending on the loan size, very, very largely, everybody, depending on the loan size we're talking about, the difference in your payment, please try not to focus on the psychology of the interest rate. Depending on your loan size, the difference in your payment between, say, a 7% interest rate today or a 6.5% interest rate in 6 months might only be $40 a month. It may not be the number that you expect it to be. So make sure that you're doing that math. I think to answer your question specifically, Kathy, I'm going to say I'm always of the opinion, if you've got equity in your house right now, go get it. If you're trying to pull cash out, I would say go get it. If it's just for the purpose of trying to improve cash flow, aka reduce the interest rate, then I would do some break-even math, and I would say, okay, I'd like to see $100 a month of savings via a refinance. What is it going to cost me to do that refinance? Is it going to be $3,000, $5,000? I mean, just use the round number of $5,000 to refinance. If you divide that by the monthly savings, you can figure out what the monthly savings would be by coming up with, right? You can work the problem backwards and reverse engineer it and say, okay, at 6.5 from where I am now, my payment reduces by $70 a month. Okay, whatever the number is. And then you can divide that by the estimated cost of the refi. And that gives you the number of months it's going to take you to recapture the refi cost versus the savings. And I think ultimately for those individuals that are just looking to refinance exclusively to reduce a rate and improve cash flow, that's the math that you need to be looking at.
So good. We actually have a webinar on that at RealWealth of does it make sense? What's going to make you money more? Debt equity, sitting in your property, doing nothing, or in the bank, or putting it to work even at a higher interest rate. Yeah. You can always refi later when the rate goes down.
Totally. And points. One thing that I don't get a lot of time to speak about, when you do the refinance, you guys, points are tax deductible, by the way. Some of the closing costs that you're going to be paying, you can use as a deduction on that Schedule E. Now, be careful with that, because the more aggressive you are with your deductions on a Schedule E, if you're still in that Fannie Freddie space of qualification, the more loss potentially or less gain you're going to show on a Schedule E calculation, and it could end up inhibiting or precluding your qualifying. So one thing I would just mention there that I really love about what we do here at Ridge is we take our clients' draft tax returns and we go through the paces. We actually go through the exercise of figuring out, based on this 2024 draft tax return and their Schedule E and all of the deductions that they're taking and et cetera, we can come back with some advice that says, Mr. Smith, this looks great, file this tax return. Or Mrs. Jones, maybe filing an extension this year based on what your goals are might be more to your advantage, because we need to buy us some time. So there's a whole, and everything in between. So you're welcome.
Good stuff. Another thing to keep in mind is when rates are a bit higher or there's uncertainty, the market kind of freezes, and it's a great buying opportunity. As soon as rates go down, then people come flooding into the market. You've got more competition. It's not as great for buying. So again, just keep that in mind. You can always refi later, but you might be paying more for a property if you wait for rates to come down. So you talked about conventional financing, you talked about DSCR. You do something that's beyond that, really super unique. I believe it's very Australian. Mm-hmm. I know a lot of Australians who they find this a very normal thing. I haven't done it yet, but I want to. So tell us about this other all-in-one loan.
Yeah, all-in-one first lien HELOC. And in fact, you're absolutely right. It was Australia that birthed this. They are the founders of this particular concept and product. It's my absolute favorite loan product for the right individual. And it's involved. Okay, so I'm going to abbreviate what this is.
You did mention there's a little more blood that you have to give for this
vials
one,
of blood,
right?
yes, and maybe some brain damage, y'all. So just be prepared. If you're interested in this, the qualification bar is going to be much higher. It's harder to qualify for this loan, but for the individuals that this works for, I do not believe there is another loan product, especially for investors, that can rival it. So it's a way in which you can combine two of our primary day-to-day drivers, two features that we're using every day of our lives. We've got banking and our housing, aka the HELOC in mortgage. You combine those two things, and that's how you get the all-in-one. You're not changing anything about your current incomes or your spending habits. You're simply combining those two features, and dollar for dollar, the deposits that are coming into your checking and savings, that let's say it's at B of A right now, Chase, Wells Fargo, whoever you bank with, you're simply replacing that vehicle and putting it into this all-in-one account, which, by the way, is housed by an FDIC insured bank. So there is, again, no difference in security or functionality or technology. All of that is exactly the same, but your deposits now, dollar for dollar, are driving down that principal balance that lives there in the form of a first lien HELOC, saving you in interest. So it's about interest saved versus interest earned in most cases. And there is a compounding effect of interest saved in two ways. The first would be daily balance. And then the second would be monthly, what's left over after everything goes out the door. And when you really start to peel this back and look at it, you'll be able to see that as a function of speed, velocity banking, infinity banking, both of those terms are also used to describe what the all-in-one is. A function of speed, you're able to diminish the amount of interest that can accrue in comparison to a 30-year amortized mortgage that's over that 360 months. I've got one example that I like to give people when they're first hearing about this and learning about it that I think helps connect the dot. I feel like in the US, and Kathy, you can speak to this too, I think, we're sort of preconditioned to understand, we're just raised with the amortized fixed rate mortgage. That's what we know. This is such a 180 to that. It's so foreign to us. I think a lot of times people take some extra time to really attach and connect dots. So as a result, I like to give this as an analogy. Okay, we're going to take two fixed rate mortgages. And remember, it's about speed. The all-in-one, the reason it's so successful in reducing the amount of interest that accrues is because of the length of time. Okay, so knowing that, imagine you've got a 30-year fixed mortgage and a 15-year fixed mortgage. Okay, on day one, both of these mortgages start with a principal balance of $400,000 each. Okay, the 30-year fixed locks at a rate of 4%, and the 15-year locked at a rate of 7%. Now, when I give this comparison, I'll ask them, which do you think you want? Which of these mortgages do you want? Without exception, people that don't understand amortization and or velocity banking, they're going to go to the 30-year 4% always. I want that 4% interest rate. But what they don't realize is that it's the length of time. You will pay $40,000 more on a 30-year 4% mortgage than you will a 7% 15-year mortgage. It's about speed. How'd I do? So I know there's going to be questions that come of that. It really does require a few times of looking at it. I've been in finance, Kathy, a long time. And when this was first introduced to me as a concept, I had to look at this darn loan for weeks before I connected the dots. So anybody that's listening, just know this is not a one-time thing. Oh, I got it. It takes a minute to dig into.
Well, and also we have the benefit of having 80,000 members at RealWealth who have been familiar with you, have worked with you. And when people tell me they did it, I'm like, really, I want to do it. Tell me how it went. And they're just really thrilled.
Yeah.
They're thrilled with how it works. And like I said, it's very common in Australia. It's foreign for us. Mm-hmm. There is so much benefit to a 30-year fixed rate. I do love that too. But if you've got money sitting around, this was the way it was always taught to me, is you've got money that you have to have in reserves sitting in a bank account. Why wouldn't you have it in this kind of, it's hard for me to explain. You explain it. But instead of having it sit in a bank account, you're making money on it, sort of.
Right. Interest earned versus interest saved. So for those, I'm going to simplify it this way, and just by saying that more often than not, okay, if you've got at least 10% left over at the end of the month, right? If you've got 10,000 coming in all in. And one of the ways that this is so unique and beneficial for investors is because we have access to those gross rents, and we can hang on to those gross rents for the vast majority of the month before we have to send it out. So that will work to your advantage. So FYI for investors, when we have gross rents, that really exponentially increases the value add of what the all-in-one is set up to do. But for those individuals that this will work for, generally speaking, okay, generally, there's exceptions to every rule, but generally, those that have 10% left over after everything goes back out the door. So if you made $10,000 a month, all sources, gross rents, net of everything else, and you have $1,000 left over, typically speaking, the all-in-one is going to outperform a 30-year fixed more often than not. And I will say this too, and I take a lot of calls on this. I am stacking up the all-in-one to 2 and 2.5 and 3% pandemic type rates all the time. And for those appropriate individuals, they're going to need more than 10% left over at the end of the month. But for the right individual, based on some other variables that we probably don't have time to go into now, the all-in-one is smoking 2.5% interest rates all the time. And the math won't lie.
And you're right. We probably don't have time to go into those details here on the Real Wealth Show, but that's why we have you booked for a webinar at Real Wealth. It's free. You're going to go into much more detail on how these different loan products work, because at the end of the day, the power of real estate is your ability to get money to acquire it, and then to have enough cash flow to cover the cost of that money, plus extra to put in your pocket. The more you can do that, and with my background in mortgages, I am so pro leverage done right? Making sure you've got the right reserves and so forth. But whenever anyone asks me, should I put more money down, or, should I do a HELOC or do a cash out refi in my primary where you get the cheapest money? It's like, yes. As long as the deal is good, you've got plenty of reserves, you can make those payments. Leverage is the key. So you're going to be sharing that at our upcoming webinar at Real Wealth. Just go to realwealth.com/webinars and you can sign up for that. I'm so excited to hear more from you, Caeli, and get more detail on that webinar, because Rich and I are looking to acquire more. This is, again, one of those pauses in the market where there's fear. Whenever there's fear, there's opportunity. And what I know and teach about constantly is the tremendous demand for housing today. And that's not going to change no matter what you're hearing in the headlines, right?
Absolutely agree.
And thank you for joining me here on the Real Wealth Show. Again, if you want to find out more about Caeli, just go to realwealth.com/webinars. I'm Kathy Fettke. Thanks for joining me here on the Real Wealth Show. We'll see you next time.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.